liquidity ratios. These ratios comment upon the ability of an enterprise to meet its short-term obligation. So students, what is the significance of calculating liquidity ratios? They comment upon the ability of an enterprise to meet its short-term obligations. That is, it actually tells us whether the business has enough ability, enough resources to pay off its short-term liabilities. Now students, remember here, we are saying short-term. So by short-term assets and short-term liabilities, we mean current assets and current liabilities. Just to revise, current assets are those assets which can be readily converted into cash, and by readily we mean less than 1 year time frame. Similarly, for current liabilities, we mean those liabilities which have to be paid within 1 year. Now remember, it is only the current assets that we use to pay our liabilities. So we can say that current assets are used to pay current liabilities. Since current assets are used to pay current liabilities, that means we must have enough resources. Imagine a situation where you don't have current assets or the quality of the current assets is bad. By quality we mean that they cannot be readily converted into cash, or they are not yielding the same amount of cash as expected. In such cases, you will find it extremely difficult to pay off your current liabilities. So now students, liquidity ratios, they tell us about the ability of the business to pay off its current liabilities out of its current assets. The first ratio that comes under liquidity ratios is current ratio. So now students, we are going to start with current ratio. What is a current ratio? Current ratio is equal to current assets upon current liabilities. That is, it gives a clear indication of how many times our current liabilities are covered by our current assets. As a rule of thumb, the ideal current ratio is taken to be 2:1. That means our current asset should be at least twice the current liabilities. This situation, that is 2:1 ratio, enables our creditors to be sure about the ability of the business to pay off its current liabilities. Now, let us move to various components. The components for calculating this ratio are current assets and current liabilities. So students, what are current assets? Fundamentally speaking, current assets are those assets which can be converted into cash within 1 year. That is, time frame is 1 year. So this includes assets like cash, bank, bills receivable, I'll put it as BR, then sundry debtors plus inventories. Inventories can also be referred to as stock, and remember, it includes stock of every kind, that is stock of raw material, stock of work in progress and finished goods. So I'll put it as stock here in the bracket. So we have cash, bank, bill receivable, sundry debtors, inventories, and prepaid expenses. Now students, remember I'll put it as dot dot here because there can be many more current assets, but these are a few ones which are used frequently. Now coming to current liabilities. Current liabilities, fundamentally speaking, they are the amounts which have to be paid within 1 year. So they include liabilities like outstanding expenses, we'll put it as complete word, outstanding expenses, something like outstanding wages or salaries which has not yet been paid, plus bank overdraft, creditors, then we can have other liabilities as received in advance. Anything that we receive in advance, something like commission, that is commission received in advance, rent received in advance, they are covered under current liabilities. Again, I'll put it as dot dot because there can be some more liabilities which we have not discussed. They can be specific to the type of industry that we are dealing with. But these are most commonly appearing ones. So now students, we know what are current assets, we know what are current liabilities. We can total current assets and total liabilities, and by dividing the current assets by current liabilities we can get to current ratio. Calculate current ratio from the following information. We are given cash 50,000, bank 1 lakh, sundry debtors 50,000, creditors 40,000, outstanding expenses 60,000, and lastly bills receivable for rupees 20,000. So now students, we are given a certain figures in mixed format here where there are certain current assets and current liabilities. So let us look for current assets first. I'll put a tick mark on the items which are current assets. Cash is a current asset, bank is a current asset, sundry debtors is a current asset, and here on this side bills receivable is a current asset. Let us put star on the items which are current liabilities. So we have creditors and outstanding expenses. Now coming to the solution part, current ratio is equal to current assets upon current liabilities. Now students, current assets in this question we have marked by a tick mark here. So let us see what is the value of the current assets. So current assets, they include cash plus bank plus sundry debtors plus bills receivable, which is given to be 50,000 for cash, bank is given to be rupees 1 lakh, so 50,000 plus 1 lakh, sundry debtors is given to be 50,000 and bills receivable is rupees 20,000. So students, the total of current assets comes to rupees 50 plus 50, 1 lakh, and this is 2 lakh 20,000. So now we have a total current asset figure that is equal to 2 lakh 20,000. Let us now calculate current liabilities. Coming to current liabilities. Current liabilities given in this question are creditors and outstanding expenses. So we can say that current liabilities for this question is a total of creditors plus outstanding expenses. Creditors are given to be worth rupees 40,000 and outstanding expenses are given to be rupees 60,000. So students, total liabilities are equal to rupees 1 lakh. Now we have current liabilities as equal to rupees 1 lakh and current assets that we had calculated just before this one were rupees 2 lakh 20,000. Once we have both these figures, we can calculate current ratio, which will now be equal to 2,20,000, that is for current assets, divided by current liabilities, which are 1 lakh. So this comes to 2.2. So students, current ratio in this question is 2.2. That means that the current assets are 2.2 times the current liabilities. The current ratio of XYZ Limited is given to be 2:1. We are required to find the total value of current assets from the following information. Now the information given here relates to creditors, bills payable and bank overdraft. That means only the current liabilities are given here. So students, for solution part, let us calculate current liabilities. Current liabilities include creditors, bills payable and bank overdraft. The values are given here, which we can take as 50,000, 60,000 for bills payable and bank overdraft is worth rupees 40,000. So the total comes to rupees 1,50,000. So now students, current liabilities are equal to 1,50,000. Now by applying the formula for current ratio, we can calculate the total value of current assets. Now the current ratio is defined as current assets upon current liabilities. In this case, current ratio is given to be 2:1. Current assets we are required to calculate and the current liabilities that we had just calculated were equal to rupees 1,50,000. So now by cross multiplying, we can get current assets as 2 into 1,50,000, which is equal to rupees 3 lakhs.